So you've definitely heard of the Magnificent 7 stocks, right? But what if I told you there was a way to trade them that aims to literally double their daily moves? Well, today, we're diving into the super high-stakes world of Magnificent 7 leveraged ETFs. We're going to break down what they are, exactly how they work, and most importantly, the massive roller coaster risks that come along for the ride.
Okay, before we go one step further, we have to get this out of the way. This is a critical disclaimer. Everything we're about to discuss is for informational and educational purposes only. This is absolutely not investment advice. These are really complex financial products, and we're just here to understand the mechanics, not to tell you how you should or shouldn't trade.
All right, so who are the stars of this show? Well, it's the names you know and see everywhere, the Magnificent 7. We're talking about the tech heavy hitters like NVIDIA, Microsoft, Tesla, and Meta. You know, the companies that basically drive the market these days. The funds we're looking at are built to track the daily performance of an index made up of this exact group of giants.
So here's our game plan. We'll kick things off by properly defining what a leveraged ETF even is. Then we'll introduce the two main players, the bull and the bear funds. After that, we'll tackle the most crucial and often misunderstood part, the daily reset dilemma. And finally, we'll wrap up by looking at the really significant risks you absolutely have to know about.
You see it all the time. The Magnificent 7 makes some huge move, and traders want to do more than just ride that wave. They want to make it bigger. They want to amplify it. That is the exact promise of these funds. So the big question is, what exactly is a leveraged ETF?
To put it as simply as possible, a leveraged ETF is a fund that uses some pretty complex financial tools, like derivatives and debt, with one very specific goal in mind: to magnify the daily returns of whatever index it's tracking. And for the funds we're talking about today, that index is, of course, the Magnificent 7.
And this whole concept really comes to life with two funds that take completely opposite bets on the market. So let's meet the bull, with the ticker QQQU, and its counterpart, the bear, with the ticker QQQD. Think of these as two sides of the same coin. Their goals are polar opposites. The bull, QQQU, is designed to magnify gains. It actually targets 200%. That's double the daily return of the Mag 7 index. On the flip side, the bear, QQQD, is built to profit when the index goes down, aiming for the inverse of its daily performance.
Let's just pause on that number for a second. 200%. That is the entire engine of the bull fund. If the Magnificent 7 index inches up just 1% in a single day, this fund aims to jump 2%. But, and this is a huge but, if that index drops 1%, the fund is designed to drop 2%. It's a double-edged sword that amplifies everything, the good and the very, very bad. Okay, this brings us to what is, without a doubt, the most critical and honestly the most misunderstood feature of these funds: the daily reset. If you only remember one technical thing from this whole explainer, please make it this one. It's that important.
And hey, don't just take my word for it. The fund's own documents put it perfectly. This quote is a crystal clear warning sign. They are telling you that these products are built to hit their targets for one single day, and that's it. If you hold them any longer, the math starts to get really, really weird, and not in a good way.
So how can this reset work against you? Well, imagine this. The index goes up 10% on Monday. The bull fund skyrockets 20%. You're feeling great. But then on Tuesday, the index drops about 9%, basically returning to where it started. The bull fund has to drop 18%. So after 2 days, the index is flat, but your bull fund is now down. That's the power of compounding working against you in a choppy market. There's a name for it, volatility decay, and it can eat away at your money.
All right, now that we have a grip on the mechanics, we have to have a serious talk about the risks. And with funds like these, let me be clear, the risks are enormous. The source material is very direct about this, and we're going to be too.
Please pay close attention to this. The fund providers themselves are stating loud and clear that these products are intended only for sophisticated investors. This isn't buried in some fine print somewhere. This is the headline warning, and it is there for a very, very good reason.
And the risks aren't just one thing. They are multifaceted. It's a whole laundry list. Beyond the huge leverage and compounding risks we've already talked about, you've also got to worry about things like correlation risk, general market risk, and even the unique risks that come from being so heavily concentrated in just one sector like tech.
But at the very heart of all of this is leverage risk. It's a simple concept with potentially devastating consequences. When you amplify gains, you are by definition also amplifying losses. This means the fund can lose money way more quickly and way more dramatically than a normal fund without leverage.
And this all builds up to the single most sobering and frankly terrifying sentence from the fund's own documents. A total loss may occur in a single day. Just let that sink in for a second. It is theoretically possible to lose your entire investment in the span of a single trading session.
So, what's the bottom line? These are incredibly powerful, highly specialized tools. They are absolutely not buy and hold investments. They're designed for very short-term daily use by traders who fully understand and are willing to accept the incredibly high stakes, which really just leave us with one critical question. Are the potential daily rewards truly worth the very real risk of a total daily loss?